Hi everyone, welcome to my YouTube channel. My name is Tabitha and today we are going to talk about Rrsp mistakes that people normally do when they are investing in their Rrsp. Why should you be careful not to make these mistakes while you're investing in Rrsp? Because you don't want to lose money, you don't want to lose any opportunities, you don't really have to pay for any penalties. So these are the main reason why you don't want to do any mistakes. So we are going to go with the list. If there are some of the mistakes that I have not listed in this video, and then you can add them in the comment section. So if you're new to this channel, please subscribe for more videos so you can get to learn more of the information on this YouTube. Subscribe and turn on the notification bell. So before we get into Rrsp factors that before we get to Rrsp mistakes that investors normally do, so we can talk a little bit of information about Rrsp or facts about Rrsp. In 2024, the deadline is February 29. So this is the time that you should have contributed to your Rrsp, max your room, because this will make a difference when you are filing your tax on the amount of money you will get back, because contribution are deductible from your previous taxable income. So if you contribute that amount, it will reduce the amount of taxable income that you will be taxed on your previous year, which is 2023. So other facts about Rrsp. So facts about Rrsp are that there is tax deferral. So when you are investing in your Rrsp, the growth and the money you have contributed is tax deferred. So it will grow tax-free. So that is also another advantage of investing in your Rrsp. But this one really depend on individual. So some people, they use Rrsp for down payment. Others, they use it for retirement. So the motivation will depend on what is the goal for the account. So those are the things about Rrsp. So you need to know the deadline, the contribution, and why should you contribute, and the advantage of investing in Rrsp, because your investment can grow tax-free. So all of those. Now let's look at the mistakes that Rrsp investors do. People who invest in Rrsp, some people, they believe that contribution is only in cash. So if the time is up and they are under pressure that they have not contributed to Rrsp, they don't know that they can also contribute some of their investment to the Rrsp, and that will really help them reduce their taxable income for that year. So it's not only cash, you can also move some of your investment, your Rrsp. Another one is like withdrawing early, making early withdrawal. So if you make early withdrawals, there will be immediate like tax. You will have to pay tax immediately, unless if it's like a project or a program that is qualified to withdraw from Rrsp without paying any tax. So if you do any withdrawal with no plan or no programs that qualified, and then you have to pay taxes right away. The amount that you withdraw will be added to your previous income. So when you contributed, the amount that you contributed is subtracted from your taxable income. Hence, you pay less taxes and you get back some of your tax return. So, but if you withdraw from the Rrsp without any eligible purpose or programs, and then that amount that you withdraw is added back to your income, your previous year taxable income. Hence, you will have to pay more taxes. So if you are really planning to use that money instead of contributing it to Rrsp and withdrawing early, it's better you just use it for that purpose and leave the Rrsp alone, because it will trigger more taxes. Unless if you are going to do something with it that doesn't need you to pay tax. Giving up the years of tax deferred growth. The earlier you withdraw, the more taxes you will pay, and you will miss out on the tax deferred growth. The investment that you could have held in that account, you will not be able to buy them because you already withdraw the money and you had no plan of keeping it further. So early withdrawal have the exception. So even if it has some maybe some disadvantage, we also have exception of how do you avoid taxes if you have to withdraw from your Rrsp. So this one say that you borrow from your Rrsp when you are doing the first home buying process. So your first home, if you're a first home buyer and you borrow from your Rrsp, and then you don't have to pay tax. And then also for the lifelong learning plan, so you don't have to pay tax. So those are the exceptions when it comes to withdrawing cash from your Rrsp. Contributing too much is another mistake that people make. So sometimes other employers, you're only allowed to contribute 18% of your previous year hand income in your Rrsp, max to the maximum amount. Yeah, you can carry room forward from previous year. That is allowed, and you also need to be aware of your contribution room, because if you're not aware, this will result into you contributing too much to your Rrsp, and because of that, you will have to pay penalties, fees, money that you could be using for something else. So you have to be careful contributing too much. So we have some more point under these mistakes that people make when they are contributing to their Rrsp. So other employers, they have pension contribution plans, and some of them have a lot of those ones. So if you have already accepted and contribute to these pensions contributions plans, and then you have to make sure that the amount that you contribute to those pensions contributions will reduce the amount of your room for Rrsp. So if your room is reduced and you are not aware of that, and then you can go ahead and contribute the same amount of your room, and then you will have to pay penalties, money. So the lifetime penalty can goes to 2,000. So you will be charged for always like over contributing. Number 4, people get the tax return back and they get excited, they go and use it for other things instead of reinvesting it back into Rrsp. So what will happen if you reinvested your money back to Rrsp? So this will help you use that compounding effect. So the compounding effects of you get the money, you reinvest it, and the more money and the more money. So this will help you grow tax deferred and faster. But if you have other problem and you want to use the tax return money, and then you can go ahead and use it for that, because different people have different needs. So that's another mistake that people do. They spending instead of investing their tax return. So investors of RSP, they misunderstand that the cessation rule. So when you have the RSP, are you giving it to your adult child? Are you giving it to your grandchildren? Are you giving it to your spouse? Or are you spending it during your retirement? So all of those things will have different effect when it comes to the rule of RSP. So if it's your adult child getting the income, the RSP, and they make any kind of withdrawal, so that amount would be tax based on their tax bracket. If it's a living spouse that is taking the same thing, so the withdrawal that they will make from that account would be tax based on their tax bracket. If we put it on the estate, so that would be really be tax maybe based on that state, because when you die, you're not making any money. So maybe the amount that they will tax it will be very small. Or above all, you can use it, and then during your retirement, let's say you decide to retire at 65 and you're no longer working, and then your tax rate is very low, so and you would pay less taxes as compared to now. So that's the importance of you contributing to your RSP and pay those less taxes. Over the years, you can be contributing and reinvesting, contributing and reinvesting. Even if that you pay tax in the hand, that tax is not going to be equivalent to the amount of growth that you have had over the years, right? So the investment will grow, there will be capital gain coming in, all those dividend paid to your account. So all that growth will be worth it in the end. At the end of the day, the CRA has to add taxes next to the next hair on the withdrawal or the tax based on the income tax bracket. Missing a contribution because of the misconception about RSP, people will have to miss contributing to your RSP and they lose those opportunities of growth over the years. So contribute to RSP, you will get the tax back, and you will also, it will reduce your tax bill, and you can also take advantage of compounding growth over the years. So don't miss on your RSP contribution. So do it before the end of the next month, and you will see the difference in your tax bill. If you were to owe money to the government and you are contributing, so you might have you might reduce your bill that you were supposed to be paying back to the government. Update your information every time that you have anything change. You have to update the information, so it has to be up to date, so we know who is going to take over your account just in case anything happened to you, and who's your trustee and who's that and that and that. Number 8 is people are not consolidating their RSP, so which means it ended of them paying more fees to different financial companies. So the amount that they are paying in fees can actually really give them some growth on other accounts like TFSA or maybe even in the RSP. Additional account fees is always there. And it will be hard for you to track your investments, so it's tough. And then the last one will be when people are sharing income, you put it together, it's also hard for you to track on what to do. Maybe your spouse is not willing to contribute to your RSP, and you have to use the RSP, or someone is using your RSP, and this could lead RSP room. This could lead to you over contributing later because someone has already used the room, all those stuff. And then you abandoning the rest of your financial picture. So you're just so obsessed with RSP, you're not diversified. So you're not using your TFSA for other things, you're not using your marginal account for other things, you're not using your GICs. So it depends on all these other sectors of your life. So some people, they plan it out. They cannot just be all invested in the RSP and not the TFSA. Like for me, if I do the GIC, I will start doing the GIC for emergency fund because they have now what they call cashable GICs. So cashable GIC, you can use it for emergency fund. TFSA, you can use it for your passive income account. Yeah, and then like RSP, you can use it for maybe if you don't have a house and you're planning to buy a house, you can do that. You want to go to school later on, you can also use it, or you use it for retirement, and then other stuff like that. So you have to be planned out instead of just putting it in one account and then you hope that in the future things are going to be okay and all this stuff. You don't take chance, so you spread out and be diversified. And if you like this video, subscribe for more videos.